Here's a number that will stop you cold. $130 billion. That's Warren Buffett's personal net worth as of 2024. But here's what most people don't know. He made 99% of that money after his 52nd birthday. Think about that for a second. Most people assume Buffett's secret is some complicated trading algorithm, some insider access, some Wall Street magic. It's not. His strategy is so simple that when you hear it, your first reaction will probably be, "That's it? That can't be it." But it is. And by the end of this video, you're going to understand exactly how Warren Buffett thinks about money, why it works so well, and how you can start applying the same principles, even if you're starting with just a few $100s. Stay with me, because the lesson that changed everything for Buffett is coming up in just a few minutes. Let's be honest about something. Most retail investors, people like you and me, are playing the game completely wrong. We check our portfolios 10 times a day. We panic when the market drops 3%. We chase hot stocks on Reddit and TikTok. We buy high, sell low, and then wonder why our returns are terrible. And here's the brutal truth. 90% of active traders underperform the market over 10 years. Not because they're not smart, not because they don't work hard, but because they're using the wrong system entirely. Meanwhile, Warren Buffett has compounded his wealth at roughly 20% per year for over 60 years. The S&P 500 averages about 10% annually. Buffett has nearly doubled that, consistently, for 6 decades. That's not luck. That's a system, a philosophy, a way of seeing the market that is completely different from how most people see it. So the question is, what does he actually know that we don't? Let's break it down. The very first thing you need to understand about Buffett is this. He doesn't think he's buying stocks. He thinks he's buying businesses. When most people buy a stock, they're looking at a ticker symbol. They're looking at a chart. They're looking at price movement. When Buffett buys a stock, he's asking, would I be comfortable owning this entire company? That one mental shift changes everything. Think about it this way. If you were going to buy a local restaurant in your town, you wouldn't just look at last week's sales. You'd want to know, does it have loyal customers? Is the food consistently good? Does it have a strong reputation that keeps people coming back? Buffett applies the exact same logic to publicly traded companies. When he invested in Coca-Cola in 1988, he wasn't just buying a beverage company. He was buying a brand, one that was recognized in over 200 countries, that people emotionally connected with, that had pricing power no competitor could easily replicate. He's called this a moat, an economic moat, like the moat around a castle that keeps enemies out. A great business has a moat that protects it from competitors. Ask yourself about any investment. What stops someone else from just copying this business and taking its customers? If the answer is nothing much, that's a weak moat. If the answer is decades of brand trust, proprietary technology, or network effects, now you're talking. Here's where Buffett's strategy gets really interesting. He doesn't just buy great businesses. He waits to buy them at the right price. This concept comes from his mentor, Benjamin Graham, and it's called the margin of safety. Here's the idea. Every business has an intrinsic value, what it's actually worth based on its future earnings, assets, and growth potential. The stock price is just what the market thinks it's worth today. And here's the key. The market is often wrong in the short term. Buffett's game is to figure out what a company is truly worth, and then only buy it when the price is significantly below that value. That gap between price and value is your margin of safety. It's like buying a $100 bill for $70. If you're right about the value, you make a profit. And even if you're a little wrong, you've got a buffer protecting you. This is why Buffett is famous for saying, be fearful when others are greedy and greedy when others are fearful. When markets crash and everyone is panicking, Buffett sees it as a sale. During the 2008 financial crisis, while Wall Street was imploding, Buffett was writing $5 billion checks to invest in Goldman Sachs. He knew the panic was creating prices far below intrinsic value. Most people saw catastrophe. Buffett saw opportunity. Now we get to the real magic. Remember that statistic from the beginning, that Buffett made 99% of his wealth after age 52? That's not a coincidence. That's compounding at work. Einstein reportedly called compound interest the eighth wonder of the world, and Buffett understood it earlier than almost anyone. Here's a simple example. If you invest $10,000 at 20% annual returns, after 10 years, $61,917. After 20 years, $383,376. After 30 years, $2,373,763. After 40 years, $14,697,715. The number doesn't grow in a straight line. It explodes. It goes vertical. Buffett started investing seriously at age 11. He was running investment partnerships in his 20s. By the time most people are just getting started, he had already been compounding for decades. And this is where patience becomes a superpower. Most people want quick returns. They want 10x in 12 months. But Buffett is playing a completely different game. He's thinking, here's a lesson most people skip, and it's a huge mistake. Buffett only invests in businesses he truly understands. He calls this his circle of competence. During the dot-com bubble of the late 1990s, everyone thought Buffett had lost his touch. Tech stocks were going parabolic. Companies with no revenue were worth billions. Everyone was getting rich. And Buffett? He wasn't buying. People called him out of touch, old, irrelevant. Then the bubble burst in 2000. The Nasdaq lost 78% of its value. Those same genius investors lost everything. Buffett's portfolio? Barely touched. He said simply, I don't understand how these tech businesses make money long term, so I won't invest in them. That's not a weakness. That's discipline. The average investor today has opinions on meme stocks, crypto, biotech, real estate, commodities, and emerging markets, all at the same time. That's not a strategy. That's noise. Buffett would tell you, know a few things really well and only act within that knowledge. This one often surprises people. Buffett doesn't just buy great businesses. He specifically seeks out businesses with great management teams, leaders he trusts completely. He's written, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. In other words, even the best CEO can't fix a broken business. But a great CEO running a great business? That's the dream combination. When Buffett acquired See's Candies in 1972, he trusted the management team so much that he essentially let them run the company independently. He didn't micromanage, he didn't restructure. He bought it, trusted the people in charge, and let it compound. That business has since generated over $2 billion in profits for Berkshire Hathaway on an original investment of $25 million. Ask yourself when evaluating any investment, do I trust the people running this company? Are they honest? Are they aligned with shareholders? These aren't soft questions. They're critical. Now, let's talk about the part of investing that no spreadsheet can capture: the psychology. Because here's the uncomfortable truth. The biggest enemy of your investment returns isn't the market. It's not inflation. It's not bad luck. It's you. More specifically, it's the emotional responses hardwired into your brain that were designed to keep your ancestors alive on the savannah, not to help you make rational decisions in a volatile market. When the market drops 20%, your brain doesn't say, interesting, prices are lower, maybe I should buy. Your brain screams, danger, sell, get out now. And when markets are ripping higher and everyone around you is making money, your brain doesn't say, valuations are stretched. Be careful. It says, you're missing out. Buy now before it's too late. Fear and greed, the two forces that destroy more wealth than any recession ever has. Buffett has been almost eerily immune to these forces, and the reason is simple. He has an anchor. That anchor is his philosophy. When the market crashes, he doesn't need to decide what to do. He already knows. He looks for quality businesses trading below intrinsic value. Full stop. When markets are euphoric and prices are stretched, he doesn't need to fight FOMO. He already knows. If the price doesn't offer a margin of safety, he doesn't buy. Full stop. Clarity of philosophy creates calmness under pressure. If you don't have a clear investment...
All right, let's make this practical. Here is a simplified version of the Buffett framework that you can start applying today. 6 steps, clear and simple. Step 1, build your circle of competence. Pick 2 to 3 industries you genuinely understand. Maybe it's tech because you work in software. Maybe it's healthcare because you're a nurse. Maybe it's retail because you spend a lot of time observing consumer behavior. Start there. Only invest in what you actually understand. Step 2, look for a strong moat. When you find a company you understand, ask the moat question. What protects this business from competition? Strong brands, network effects, switching costs, cost advantages, and regulatory licenses are all forms of moats. If you can't identify a moat, move on. Step 3, evaluate management. Read the CEO's annual letters. Watch interviews. Look at their track record. Are they honest about mistakes? Do they allocate capital wisely? Do they own significant shares in the company? These are good signs. Step 4, estimate intrinsic value. You don't need a PhD in finance to do this. At its simplest, look at the company's earnings, its growth rate, and compare it to similar businesses. If a company earns $5 per share and is growing at 10% annually, what would a rational buyer pay for that stream of earnings? That's your intrinsic value estimate. Step 5, apply a margin of safety. Once you have your estimate, only buy if the stock is trading at a meaningful discount, ideally 20 to 30% or more below your estimated value. That gap is your protection against being...
Let's bring this home. Warren Buffett is not a genius in the way most people imagine. He's not running complex algorithms. He's not trading on inside information. He's not making wild bets. He's doing something far more powerful and far more accessible. He's being rational in a world of emotional investors. He's being patient in a world that demands instant results. He's being disciplined in a world full of distractions. The 5 core lessons from today: 1, buy businesses, not stocks. Think like an owner. 2, only buy at a discount to intrinsic value. The margin of safety protects you. 3, let compounding run. Time is your most powerful asset. 4, stay inside your circle of competence. You don't need to have an opinion on everything. 5, master your emotions. Your psychology will determine your results more than your strategy. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." And in 60 years of investing, he's never found a reason to doubt that. If this video helped you see investing differently, hit that like button right now. It genuinely helps this channel reach more people who need to hear this. And if you're not subscribed yet, subscribe and turn on notifications. We release videos every week breaking down real investing principles in plain English, no fluff, no filler. Now, here's the question I want to leave you with, and drop your answer in the comments below. If Warren Buffett looked at your current investment portfolio today, what do you think he would say? Would he say you're thinking like an owner? Or would he say you're gambling? Be honest with yourself, because that answer might just change the way you invest forever. I'll see you in the next one.